Wednesday, October 23rd, and I have some exciting news. I'm excited about it. I don't know if you're excited about it. They reached out to me yesterday, this Wall Street Breakfast. It's from Seeking Alpha. It's a podcast. They said they have 5 million listeners. Full disclosure, I do not have 5 million listeners. So when somebody says, hey, we've got 5 million listeners and we'd like to interview you because we're big fans of your podcast, you say yes. And so I sent them the outline of what I want to talk about yesterday. I will be a guest at some point in time. I am a big fan of theirs, and just mentioning that to a bunch of people here on YouTube Live in the morning, they said, hey, we're fans of this one too. It's a nice 5-minute in-depth dive. The plan was, hey, they're going to interview me. We're going to go over podcast, me, blah, blah, blah. It would just be nice to have somebody to talk to be honest, because I sit here every day and talk into a microphone. I don't know about you guys, but it's weird as F for me to sit here and talk to myself on a microphone. So it'll be nice to have somebody to talk to and ask me questions. And then I can mumble on in my ADHD, squirrel, rabbit. But it'll be good. It'll be good. Let's talk about the Qs, because like I said, the past 2 years, we've had those 3 downturns. We've only really had 2. And so am I expecting the third? Yes. What could be the cause of the third? It could be the election. We talked about it yesterday, how the VIX is going to be key. The VIX, I was on Spaces yesterday with a Jim Cramer's quote-unquote VIX expert. And yeah, we gave him some crap, just so you know. But Jim Cramer, by the way, just full disclosure, absolute genius in markets. Bad stock picker, absolute genius in market, knows everything that the markets. I mean, just really smart man. But stock picker, yeah. As WULF put it yesterday, if you bring up, does your investment club beat the S&P, you will get blocked. We know that from experience. Just so you know, I'm blocked by Jim Cramer and by Tom Lee. Either way, I still do fine in the markets. It's okay. But the Qs, we're up at that 500 mark. We're at 496. So do I expect a pullback in the morning? We're at 494. It's just ho-hum. I think you're going to see Tesla earnings today drive this market. But what I want to bring up is, and I may not mention this enough, Leon Cooperman talks about the Nifty 50 all the time. And with Boeing reporting today, and there's a Wall Street Journal article out, I think, about this, but he was just on CNBC, and it just rang true to me. If you go back 20 years, now the Nifty 50 were the 1970s. So that's like, 50 years ago? That's my lifetime, okay? I am older. There's another generation before me who knew the Nifty 50, late 90s babies. I was born in 1970, late 90s, maybe 2000 babies. They knew these 3 companies at great American manufacturers. And who I'm talking about Intel, I'm talking about Boeing, and I'm talking about GE. They were all great manufacturers. And over the last 25 years, these companies have fallen and their stocks have fallen. Now, GE is on the rebound, but Boeing and Intel, not on the rebound. Go and take a look at the charts. I'm not going to bring them up here, but go and take a look at the charts. Some may not be old enough to realize this, but they were fantastic companies. They were good companies with good products, with good earnings, and good management. And then something was taken out. And you see, these are not companies that have been good to hold for the long term. Okay, GE for the last 5 years, absolutely. You've been able to hold this one. And it's because they have new management. For the years before that, you weren't able to hold that one. So we can go and look at a monthly chart of GE. Look, that's the year 2000. The stock was trading at 268. This is not one that if you held Apple during the same period, you're a millionaire now. If you held GE, you lost money. And I do know somebody who retired in 2010, and the majority of their retirement through 2000 to 2010 was in GE. And so they couldn't retire. They just had to keep on working. So when you see these companies and you see it, I want you to make sure, this could be Apple. This could be NVIDIA. This could be 20 years from now, the companies that you see that are leaders today, the Magnificent Seven, if they don't invest in their own, it's not like any of these companies are being hurt by cheap overseas products. No, it's bad management. That's how important that is. So when I talk about that, understand bad management, even though I think Elon right now is a poor manager of Tesla because he promises things, but he comes through in the end. It's not like we're waiting. He may promise things next year and then you have a 2-year wait on top of that. That's not like promising it tomorrow and giving it 10 years from now. So even those things that Elon does, he's still a good manager. So I just wanted to point that out. That, hey, Wall Street breakfast, and I wanted to point out the Nifty 50 because I think it's good to keep in your mind. Now, Rick Santelli, he was on a roll last night. I was looking for this clip because it was so fantastic. He's talking about bond rates that can quickly go from 5% to 15%, and it's happened. And the economy didn't do well. Just FYI, the economy didn't do well. So listen to this. It's 5 minutes. It's really a good discussion, kind of to put in the back of your mind. Again, we're in a bull market till we're not, so I don't want to scare you, but I want to make sure that you're aware that there are things. We talked about it on Spaces yesterday, and one of the things that stuck with me overnight was it's never the thing that's in front of you that takes the market down. It's the unknown that takes the market down. And so that's what I want to say. Hey, that's it. Now, I did do a chart yesterday, and I won't put it up there today, but and it was on Spaces. Maybe I'll do it for the newsletter. Maybe I'll put it in the newsletter. But I find it funny that and you can Google this, GDX, okay, gold miners. I'm going to throw this in the watch list because here's the important thing to know. GDX is up 42%. Okay? I got a dog crying. GDX is up 42% year to date. GLD, which is gold, is up 32% year to date. S&P up 22% year to date. You could play BAR, which is another ETF on gold. But I just wanted to point this out because this one has just been in a run down here at 26 and now you're at 44. This is gold miners. And if we go and look at Seeking Alpha, and I changed my Seeking Alpha to dark mode, I learned how to do that. And God, it's changed my life. Absolutely changed my life. But year to date, gold miners is up 42%. When you go over here and you look at holdings, Newmont, Agnico Eagle miners, which is the one that I think Jared Dotarnova talked about when I was listening to God, I forget his podcast, but I was listening to him. That's the one that he was talking about. This is one up 79% in 1 year. Okay. Year to date, it's up 67%. So you can look at these. It's an interesting one. This is a great ETF, GDX. It's got an A+ on momentum, C on expenses. Now we can go over here and we can look at peers. Are there other gold miners? Yeah, you can look at the VanEck gold miners, junior gold miners, global gold miners, spot gold miners ETF. This one has a 0.50. They're all kind of in there. Pick is the metals and mining production. Go and take a look at them. But GDXJ, which is the junior gold miners, that's over 1 year up 61%. Year to date, that's up 46%. Ring, which is the global gold miners, that's up 48%. So you take a look at this. Again, this is how I use Seeking Alpha to just go down this rabbit hole of stuff. Let's talk about McDonald's, because not only is McDonald's killing you if you eat this because of their meat, but they are killing you with E. coli as well. Yes, one person is dead. I am not slandering the company at all, but yes, one person is dead, unfortunately. So what I want to point out is the stock price. And pre-market is down 6%. This was down as much as 9%. We'll go and take a look at the chart. But I want to point out that CMG, Chipotle, had an E. coli breakout. And while they went back, they pulled back. Hold on one second. Penny, I love you, but stop. Okay, so McDonald's, you've had this run up. Now in pre-market, you're trading at 293. That brings you all the way down here. Look at where it popped to back here in January. It's pulling back to there. And that's what's interesting. It's pulling back to there. It's going to use this as a support. Now, if it doesn't use this as support, where's the next support level? 270. Because you're seeing that pop up right there, and you're seeing this pop up before a pullback. So I would use those stare downs on the 4 hour as to look to support. But if we just go look at CMG, okay, remember, this is why the CEO went to Starbucks, is look at these E. coli breakouts, okay? This was during 2021. It pulled back to 28. You're at 60 right now, and that's 2 years ago. So I do think that the McDonald's E. coli, it all depends on how the management responds to this and whether it breaks out, because their supply chain is so tough. And this is, again, these are burgers that are frozen and then cooked in high heat temperature. How does E. coli last? I don't know. It's an interesting thing. I don't know, but the article points out, hey, one person has died. It's a pretty big outbreak, and it's big enough to bring down the Dow. Now, let's talk about Tesla, because they report after earnings. And I said yesterday, and I put it in the newsletter, about I think TSLQ is the play. Ironically, and we will look at this. So Tesla's in the core portfolio. It's not that I don't believe in Tesla, but you had a buy in the algorithm at $217 yesterday. You're trading right there at 217.20 right now. The algorithm makes you 170%. Buying and holding over 2 years makes you 3.1%. Now, this article is all about what people are looking at. They're eyeing margin updates, their delivery guidance. I put in the newsletter yesterday, and we'll go over to the newsletter so I can show you this chart. Their deliveries are suspect. It's suspect as to whether these deliveries. Now, this is the commercial free version, but it puts you basically get. I'm going to pause that one. But this chart, these are their deliveries by quarter and by year. And you can see they are running behind. So it's not a great situation to look at. And when you eye margins, when you eye deliveries, they're currently making more cars than they can sell. The robotaxi event was a flop. Elon's way too political, with the governor of Pennsylvania saying he's breaking the law by paying people to sign his petition. They just offered 0% financing with FSD, and less than a week later, they yanked the FSD component because demand wasn't there. Remember, they're eyeing margins. What's the high margin product? It's FSD. I can't imagine they were able to cut costs in order to improve that margin. So software was the way that they were going to boost up the margin. And if you're charging $8,000 for a software package, that's the life of the car, but you can get it for $99 a month, where most people aren't using this on a day-to-day basis. They're using this for road trips. If I can sign up for $99 on a month where I'm doing a road trip, I don't necessarily want it. The valuation of this is too high. A car company. Right now, it's a car company. It is not a software company. It is not a self-driving car company. If you want that, you buy Google. The valuation is just too high. And so that's why I think TSLQ is the play. Those 6 reasons. I'll put those 6 reasons in the newsletter, but it's those 6 reasons. So, obviously, if you look at this and Tesla is a buy in the algorithm, is TSLQ a sell in the algorithm? No. And the reason is because this one's daily, twice leveraged. So do I think that you could buy this one in pre-market? It's up 0.51%. I think you see this one peak above this 200-day. That 200-day is at 28. I think you see a peak at some point in time. Again, you make 44% versus losing 50% in the algorithm on this. Just have a strategy out there. Now, One that I don't have a strategy on, I just look to enter, is Microsoft. And it's days like yesterday that you just want to have Microsoft. It was up for absolutely nothing. There was no reason Microsoft was up. None. We can go and look at it. Their co-founder Gates donated $50 million to Harris. Nothing. BlackRock launches 2 AI ETFs. Nothing. OpenAI hires first chief economist to better do it. Nothing. OpenAI works with Lenfast Institute. Nothing. Amazon backed Anthropic AI tool Claude. That's yesterday. There was no news yesterday. Now, the only thing, Microsoft to offer AI autonomous agents from next month, that was on Monday. There was nothing. Nothing. You know what else was up yesterday? NNE. Okay? I'm sorry. This one pulled back. This is nano nuclear energy. All of the energy names, all of the nuclear, they pulled back. Oklo was down 6%. It's down 3% again in pre-market. Nano nuclear energy was down 13%. It's down 3% in market. Now, I went down this rabbit hole yesterday. And what I looked at yesterday was interesting. I found this FLUAR. This is an industrial construction and engineering company. It wasn't down yesterday as much as the rest. It does have a nuclear component. It's construction and engineering. This is an interesting one. It's a buy in the quant. It's valuation. It's a D, but again, the PE is not crazy. It's because of the growth. The growth, they're only growing revenue 4%. But when you look at levered free cash flow, they're losing 39%. That's essentially, but when you look at operating cash flow growth, 176%. They're spending money. They're spending the money. That's what it is. They're spending the money. That's the profitability. So the gross profit margin is only 3%. But I like this one. I sought this one out, and I looked at this when I was looking at nano nuclear energy. It's number 6. You can look at the other ones. It's got a $9 billion market cap. You can look at MCore, which has got a $20 billion market cap. AGX, Argan. It is a portfolio, I believe, ad in recent time. Maybe a time to promote, I can't say it, but maybe a time to promote alpha picks. 2 data-driven stocks each month. Alerts when to sell. They give you 1 pick on the 1st, 1 on the 15th. Maybe. Just kind of saying. Can't say it. This is what we're going to look at. Spotify reportedly working with trading desks to launch its own ad exchange. This is interesting. This would be a big move. The trading desk and Spotify. And one of the things that I looked at yesterday was, or I heard, a great debate. Is Spotify like Netflix? So we can go, let's go and look at, we're going to edit these symbols. I'm going to take out a live entertainment. I'm going to take out TKO. I'm going to take out everything. We're going to look at Spotify just versus Netflix. And we're going to look at the fundamentals, the chart, the performance, everything. Okay. Year to date, Spotify's up 106%. Netflix up 56%. Again, their market caps completely different. So Netflix is $326 billion. It's one of the Mag 7. Spotify is not. It's up 77. Okay. Quant ratings, they're both a hold. Seeking Alpha rating, Spotify is a hold. Netflix is a buy. At Wall Street, they're both buys. We can look at the sector ranks of these things. We don't really care. Quant ratings, they're both about the same. Now, last close, total return, you can see 1 month return. Netflix is beating 9%. Spotify's up 6%. You go out 5 years. Spotify's up 228%. Netflix is up 186%. 10 years, Spotify wasn't even around. Neither one pays a dividend. Now, when you look at PE, Spotify's not making money. They're expected to make money, but they're not making money. The forward PE is 44. Okay? The PE for 3 years, it goes out to 35. Now, Netflix is 27. They're expected to continue to grow. It's international. It's blah, 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 the whole thing. Now, trailing 12 months, PE, it's 155. Again, that's trailing 12 months. We really don't care about that. PEG ratio. Spotify doesn't release a lot of forward numbers, so you don't really get a PEG number. Price to sales, that's a big one. Look at how cheap Spotify is, $4.93 just compared to sales. That price to book, they're both about the same. Price to cash flow, both about the same. Netflix is cheaper. Revenue growth, this is why you're paying more for Spotify, 16% year over year. Netflix, 14%. When you're as big as Netflix and Spotify, it is hard to continue to grow at that. When you look at profitability, Netflix at 45%, they have pricing power. Spotify, 27%. It's not as good. So it's a toss-up here. Again, it's a toss-up here. You can look at these, all of these kinds of things and just compare them. But what I thought was the biggest one was this. Spotify is outpacing Netflix. I continue to think that Netflix is an undervalued price. I think that they continue to grow. Spotify, I like the stock as well. In fact, I own Spotify in my Webull account. So I thought that was an interesting one. One that held up yesterday, ironically, was WULF. WULF, remember we talked about that? This was up 5% yesterday. It's down 5% in pre-market today. But this is the one that does nuclear and crypto. It's a miner that does nuclear energy and crypto. You got the best of both worlds. It held up. It was up 5% yesterday. So I thought that one was good. One article that I think boosts what I think about ARM. Now, both of these are down in pre-market. So take this with a grain of salt. But ARM is about to cancel Qualcomm's contract, and they can do this, which means Qualcomm can't sell any chips that are made on the ARM architecture. That's essentially what it does. It's that license fee. It is the subscription-based fee that consumers hate because you have to pay for stuff every month. But ARM is, the only problem with ARM is the valuation. It's the valuation. Even the PEG ratio makes no sense. But if they have that much power that they win out over Qualcomm and Qualcomm can't sell the chips, I think that moves me, this one, ARM, into something that I want to keep a watch on. So I'm going to put this, it's already on our watch list. And you can see it trades here between 100 and 170. And you're trading at 152 and it's coming down. Maybe the valuation's coming, just kind of catching up with this. So another interesting one, and this may be just self-serving, but Disney reported not letting new users sign up via Apple's App Store. This kind of interesting because it hits home. Substack contacted the best sellers on Substack, and I'm one of them, thanks to you guys who support me. I am one of the best sellers, so I'm able to get these insider information. Substack is being told by Apple that in order for their app to be continued to be on the App Store, they need to allow payments within the app so that when you guys subscribe to my newsletter, it is through the App Store. Now, I'm a big believer in Apple, but Apple is taking an additional 10 to 15%. I forget the amount, and it depends on how much you sell, but it's 10 to 15%. So I, as an author, have the ability right now to not allow payments in the actual app. Now, what Apple and what Substack has told me is you can double the amount of money that you make because more people tend to subscribe if you allow that ease of, hey, we're just going to pay with Apple Pay. So I'm able to increase revenues, but the additional money that Apple takes, Substack is going to take that out of the payment. So right now, I don't even know how much I charge. I am going to have a Black Friday sale, just so you know, on the newsletter. I will have a Black Friday sale coming up probably in November. But I don't even know what it is. Honest to God, I just got to think about it. If you guys have an idea for Black Friday sale, just throw it out there and tell me what you want for the paid newsletter. But I don't want to let payments because right now, just to give you an idea, I think I give away 35% in fees. Of whatever I charge, 35% goes in fees. So that's it. I mean, you can think what you want. I think this is an interesting one because if Disney's able to get away with this and hold Apple, Apple may say, you know what, we're not going to allow Disney Plus to be downloaded in the store. And so we're going to take it off of Apple TV. We're going to take it off of the boxes. we're gonna take it off of the iPhone and the iPad, so people won't be able to watch Disney Plus. It'll be interesting. I mean, that's a huge play. Now, BlackRock launches 2 new ETFs that tackle AI growth and opportunities. The 2 new ETFs, BAI and TEK. Those are the 2. You can take a look at these. This is iShares. That's what BlackRock owns, iShares. Number of holdings, 34. Number of holdings, 57. You can see the top 3 holdings, NVIDIA, Microsoft, and Apple for TEK. Top 3 holdings for BAI is NVIDIA, Meta, and Microsoft. Expense fees, not crazy, 0.68. But why wouldn't you just buy these companies yourself? I mean, go and look at the holdings. Just go and Google them and see what they're holding. They're actively managed ETFs. They're easier to own, through the ETFs. But in my mind, just, you can do it. And BAI and TEK will be the latest ETFs to join several existing funds that are focused on AI and technology, and they put it all down there. This article will be in the newsletter if you want to watch it, if you want to see it. This is interesting, okay? Stride, LRN is the symbol. And we're into the earnings section, but Stride is something that I noticed. LRN is a stock. It's an educational company. I don't know anything about it. Educational technology company. I noticed it this morning, and I did a little research. LRN, let's go and look at the chart, because what I want to show you is October 8th, how this one fell, okay? This one started to fall on October 1st. You can see the algorithm gets you out there. Nice 0.4% loss. Saves you from this downside all the way from 83 all the way down to 64. Okay, and then they have their earnings today. This was a short report published on, I guess it was October 16th, but the news came out like around October 2nd, and that's when it started to drop. And what I want to show you is they had earnings today. They're up 26% at $82, okay? So if you bought this yesterday, you are back up here to where you were. So a short seller's report comes out, then the actual earnings comes out, and the company continues to go up, okay? There's a couple of companies that we watch that are very similar to this. SMCI is one. Their earnings are coming up November 4th. Okay, the algorithm has you in at 42. Is this going to be a company that comes back up to $80 or $90 and crosses that 200-day because their earnings and their margins are so strong? Could be. Another one is Roblox. Remember, they had a short report that pulled them from $47 or $48 down to $40. And I said a couple of days ago, Roblox has a cross up. You should buy it under 40, and you absolutely had the chance to buy it under 40. Where are you now? 42.33. You'd be up a nice 5% in a couple of days. It's up 2.5% in pre-market. So Stride just kind of proves any reaction in the market is an overreaction. As long as the company is a good company with good products, with good earnings, and good management. Now, the earnings part, you could say Roblox isn't making money, but they've got a great product. So I like that one. Another company, NextEra Energy. They missed Q3 top line estimates. This is a high flyer. We can go and look at this one. They're up 0.22% in pre-market. So even though they missed, they reported strong earnings, growth across businesses in Q3. Year to date, this is up 37%. You want to know why XLU is up? It's because of this. NEE. This is a utility. Okay, they've got a nice yield of 2.46%, $172 billion market cap, nice and big. Wall Street, average price target, 86, it's trading at 83. They've chased it on up. You can see, is it at all-time highs? Nope. Not even close. NEE, they had a good reading. So that one's a good one. Now, Coke, key takeaways from Coke. We talked about Coke. This was trading at 70. We can go and look at Coke in here. This is in the core portfolio. I hold this one. This one ran all the way up in August. It ran all the way up to 73. And here in October, it hit 72. You had your opportunity. Algorithm got you in at 70, got you out yesterday at about 69. In pre-market, it's at 67. Now, this 60, this was for a while, quite a while. Buy under 60, sell over 60. And you had an opportunity to get it here at 54. That's not a bad move. From 54, October of last year, all the way up here for 1 year, that's a good move. Now, the key takeaways, organic sales shine. North America outperforms. Margin march higher. So essentially, even though they had rising costs, they were able to raise their prices and margins marched higher. That's a pretty strong consumer. Again, sugary drink, pretty strong consumer. We talked about AT&T beat. Okay, it's a mixed quarter for AT&T. We can take a look at that. You can take a look at that chart if you want. In my mind, AT&T, just take a look at a long-term chart of AT&T and you'll kind of get it. Boeing, it's another mess. Did horribly as expected. And the only thing the new CEO had to say was, hey, we got a labor deal. Hey, that's fantastic. It's fantastic. You just screwed over employees, for the last 5 years, and you finally gave them a raise. A good company. Again, this is why it's out of the core portfolio. I just couldn't deal with it anymore. Now, Starbucks, on the other hand, new CEO. It suspended guidance. So the new CEO comes in and says, you know what? I don't know what's wrong with this business, but when they pre-announce, it's never good. And the new CEO said, hey, we're going to turn things around, but it's not going to be on day one. So we're not going to give you guidance. That's never good for a stock. It's down 2%. So in my mind, Starbucks, remember when he was announced, and this is the guy from Chipotle. This is the guy who did the deal. You can see on this one, this was the day, August 8th. It was trading at 75 and it popped up to 95. Where would I expect support to be on this one as it starts to fall? I would expect it to be 80. You're at 96 right now. I would expect, without guidance being given, without any explanation, I would expect it to come back there. I don't like this name. I don't like it. Again, I think they had a Pepsi CEO who came in and said, you know what? We're going to add more sugar to our drinks and we're going to use coupons. And that's not what the clientele of Starbucks wanted. And so you're seeing that. And now they have more options and it's going to be tough to get them back. But the new CEO, great CEO. He turned around Taco Bell. He turned around Chipotle. He knows what he's doing. So I believe in him, but I'm not ready to buy in right now. I'd rather buy in when we see a sustained move and not this crap of, hey, we're going to pre-announce and we're going to suspend guidance. Vertiv. Okay, this is a company that I sold at 109. They beat and they raised full year guidance. This was clearly resistance. And we'll pull this up, and I showed you right here. The previous all-time highs in May was 106, 107. So at 109, I was selling, even though it looked like this one was going to be support because it did pull back a couple of candles here, and it used it as support. I was like, maybe I do want to buy this. But earnings were coming up. I was fine buying higher. They beat. They did really well on earnings. And what happens? It pulls back. The people just, on this high of flyer, they're taking profits. The MACD needed to come down. The RSI needed to come down. It's coming down. So look for this one. VRT, we can look at what Wall Street thinks of this one. Again, Wall Street says it's a strong buy, and they've chased this one up all the way up. Their average price target, 114. I would expect 114 to be in the bag again. This is an electrical company. Electrical components. This one has been, again, the valuation is the only thing against it. But the PEG ratio, the growth, super strong. Super strong. It's the only reason it's not an F is because of that PEG ratio. So, again, we're in earnings season. This is the time to look at it. Tesla is tonight. You can take a look at it. You use Earnings Hub. I love Earnings Hub. I'll try and be live for Tesla earnings tonight around 4 o'clock. I think it'll be interesting. I can talk about it, answer any questions that you guys have. We can look at the charts. You can rub it in my face if I was wrong about TSLQ. You can say, douchebag, why'd you tell me to buy TSLQ? Well, my answer to you will be, do not listen to a douche on the internet. That's just it. Take a look at some stocks. Yesterday, as I was signing off, Brandon asked me to look at MBLY. And those of you that know Brandon, you know, probably about 4 months ago, we had a complete podcast that was commercial free, thanks to a tip from Brandon, who sent me a nice little Venmo, as a thank you. Mobileye. Okay. So I don't know much about Mobileye. I think they're an Israeli company. I think Intel owns them. There's some tie in there, but I'm not a super like up to date. Oh my God, I'm an analyst. I know exactly what this is. From a chart, I see gaps above. I see this one based on earnings. I see this one based on probably some type of pre-earnings. But in my mind right now, what I see is an upper left to bottom right. Let's take a look at the weekly. Same thing. I'm just seeing something that probably IPO'd back here, and it's just upper left, bottom right. And I don't see any reason. I don't see a 200-day, so it's new. So let's go over to Seeking Alpha, and let's look at MBLY. Now, I don't want to time the bottom. I think Brandon's a bottom kind of feeder. Mobileye is at high risk of performing badly. Learn why. Let's see why. The company has 3 million price performance of 3-month price performance of minus 27%. So it's the momentum. It's the momentum that they're identifying as a risk. And look, 9-month performance, 3 months performance, 1 month performance. There's not a month here that you can make money. Now, Wall Street says it's a buy. 27 analysts cover this. They said the average price target is 19. Okay, did they chase this up? I would say they're chasing it down. So I'd rather buy this one when it turns around. I'd rather pay something like 20 on this than pay 10. Because right now it's at 13. I'd rather pay 20 and have it jump to 40 than pay 10 and have it jump to 5. I mean, the growth sucks. Profitability, it's okay. I mean, gross profit margin 47%. That's great. That's fantastic. But look at all the returns on assets. They're not spending wisely. Momentum sucks. Revision sucks. 23 earnings per share down. 23 earnings per revenue down. I don't see this one as good. Dan from LinkedIn. I was thinking about adding a defense stock in my IRA LMT. I went over this one yesterday. I'm not a fan of defense stocks. I'm just not. I think defense stocks aren't defense stocks. I think they're offense stocks. I think they wind up killing people. And so that's the weapons that you want to invest in. For me, ethically, I'm just like, I could make money in it, but I think there's better places to make money. If we look at a 10-year on this one, it's been a good one. I mean, look at it against the S&P for 10 years. You've outperformed the S&P. So 5 years, you've underperformed the S&P. 3 years, you've underperformed the S&P. 3 years, you've outperformed the S&P. 1 year, you've underperformed the S&P. So it's a mix. I don't think it's a bad one. You can just keep an eye on it. We talked about the Nifty 50. You don't want to be in a company that's just floundering. Earlier this year, you were trading, between 456 and you couldn't get out of this range. All of a sudden, you're outpacing that range. So I don't think it's a bad one. But again, I don't know the defense industry. I don't know. Lockheed Martin seems like a good long-term buy, but it's not for me. Raphael, I know you mentioned Dell a few weeks ago. Do you think it's still a good long-term buy? Also, just want to give you props for calling out Uber and Shopify as $80 stocks. We all get lucky sometimes, Raphael. Let's look at Dell. Because Dell, I do hold in my portfolio. It's a strong buy in the quant. And it's been a strong buy in the quant. And you're lucky because it has pulled back quite a bit. Because this one, the 52-week range, is between 63 and 179. You are sitting right in the middle of that day range. Now, short interest is 4.2%, so you can't argue with that. It's been a strong buy here since 114. You're trading at 118. Okay, it was a buy up here, a hold up here when it was up there. It was a little bit stretched with that valuation. When you look at the PE, it's not crazy. The PEG ratio, not nuts. They're pretty good. The growth, that's where you're kind of getting screwed, is because the revenue growth, they're down 1%. They've been doing fantastic. And the growth is where you're getting killed. The profitability, A+. On their earnings, this margin is what brought them down from 160 to below 100. That's what did it. And when we look at this chart, that's the earnings that just brought this one down. It was overvalued. I mean, honest to God, at this point in May, it was overvalued. I started adding back here at 113. Did I add at 92? No, I added at 109. So I've been adding a little bit here and now and then. That green bar that you see right there, that is on the weekly chart. That is going from the March 2023 lows when they really started kicking ass. And I said, okay, I want to see where this trend line does. Does it hold up? You might see some resistance on this, as you're seeing right now. And old resistance could turn into new support. Look, on the weekly, the MACD has turned around. The RSI has turned around. Their earnings are coming up November 25th. So it's later. It's later. The algorithm makes you 209%. Buying and holding over the last 2 years makes you 251%. And if we just run this, where are we? I think we're still in a buy. You're in a buy at 120. I can tell you from just looking at this, you probably will be a sell. So is it a buy? I think it's a fine buy long term. I don't think, the server racks and PCs, I don't think they're going away. So I don't think that the valuation precludes me from saying that this company could do really, really well. I trust in Michael Dell. The other thing that you're dealing with, Dell, is that Michael Dell is buying or selling a shit ton of stock. And so look at this. That's all Michael Dell. And that's not like small. He sold $1 billion worth just on September 26th at 122. It's being held down by these sales. And that's the part of the problem. So once he stops selling, this is like Bezos. Once he stops selling and stops collecting his hey, I need money to live on. I need $1 billion because I need that house in Venice, which is going to be underwater. And then I need to replace it because I have to build it up 6 stories because the water. That's the kind of shit. Venice is going to be his backyard swimming pool. That's how much he's selling. So Raphael, I think it's a good one. I own it. It's not in the core portfolio. Probably should. In fact, I do have it in the core portfolio. I put it in there. It's down 1%. I would say anything under 120, you're probably fine. Again, for the long term, I think 5 years from now, Dell will be fine. William, Gary, hope all is great with you. You've been on a roll this week. I wonder if you could tell me what the charts tell you about GLW. I got the idea from Josh Brown, who, by the way, is my favorite. I love Josh Brown. I subscribe to his newsletter. I listen to the Compound podcast all the time. I love Josh Brown. I love it for picks and shovels. Options action tells me it has more ways to go. So GLW, the algorithm makes you 56%. Buying and holding makes you 52%. This is Corning. And this is they make glass for fiber. All of the AI stuff, that's what these guys do. Their earnings are coming up here October 28th. So what, next week? I mean, in my mind, I think this one's good. I agree with Josh, and I wish I would have gotten in when he actually got in. When we look at this one, the valuation, it's a D. It's a D. The PE is a little bit expensive. The PEG going forward, it's 1.77. But this sector, electronic components, this is number 11 out of 20. We'll look at that. The growth, minus 6%. Not great. Not great, but again, if there's a company that could do it, good company with good management, maybe they've got it. Gross profit margin, 34%. The sector is getting 50%. So they don't actually have pricing power. The run may be over. But if you look at this, Corning, GLW, it's number 11. Kosciera, KYOC is up there. We can look at this TTDKY. That has a $22 billion market cap. You can see the valuation's really good. Wall Street says it's a strong buy, but there's only one analyst that cover this, and that's trading at 11. Everything looks good on that one. We can go back and we can look at the number one. Airgen, this is a small cap. It's $102 million market cap, so I kind of take that with a grain of salt. But when you go over here to top stocks, I say that knowing full well, PSIX isn't the top one anymore. Oh, let's see where that one went. This is Power Solutions. This has been the top stock in the quant for a while. It's still 4.99. Huh. Interesting. I don't know why. I don't have any filters on. Interesting. It's still 4.99. I guess it's not new. QFin is the new one. So, but yeah, William, I like Josh Brown. I wonder if he's just gotten in it a little bit earlier. What are your thoughts? Dex wants to know my thoughts on RTX. I went over it yesterday, and I'm not a huge defense stock guy. I just don't like defense stocks because in my mind, defense isn't defense. It's offense. And so, you got war in the Middle East. You got war in Ukraine. It is what it is. I just, for me, I think there's better places for me to sleep at night to invest. But this isn't a bad one. You can look over, we can look at the charting against the S&P. You look at it over 1 year, it's up 71%. The S&P is only up 38%. You look at it 3 years, it's still outpacing the S&P. Look at it 5 years, it ain't doing well. You had that drop. So I think you're just catching up. You go out 10 years and it's really not doing well. But that 2020 kind of drop, it just hasn't recovered per se. But it's doing fine in the short term. 6 months, you're up 24% versus the S&P up. So again, I'm not a defense guy. So I'd love to give you an idea, Dex, but I'm just not a defense guy. From Spotify, thanks for talking about fractional shares today. I use Fidelity Basket Portfolio. It's $5 a month, but works with all my Fidelity account. It's pretty good interface to easily set up. I use it to follow your daily stock pick core portfolio, alpha picks, and others. Have you messed around with it? I don't think it's very well advertised by Fidelity, but I find it very useful. So what this does is Fidelity's basket portfolio. You can set up the percentage in your portfolio that you want a certain stock to be. And so what it does, I don't know if it's monthly, weekly, or daily. It goes and automatically rebalances that for you so that stocks don't get out of balance. Now, that's a very simplified way of doing it. But Jay, I think it's a great product. I think Fidelity is amazing. I think they offer incredible tools. This is the reason why I tell you to have a brokerage that is a full service brokerage. It's fine to trade in Webull. And yes, Webull is my preferred trading platform. I use Webull. I have a $1,000 account that I turned into $9,000. I'll look at it right now to see. I'm at 9281. It's mostly NVIDIA and iBit and Apple and Spotify. I think those are the major ones that I hold in there. But again, it's just betting. And so there is no way I would take my big portfolio of millions and millions of dollars and use it like I do Webull. And Webull and millions of dollars gets you benefits in Fidelity that you don't get in Webull. You get a personal financial advisor that you get. I get free TurboTax. I mean, God, you think about it. I get free TurboTax. Don't ask me why I think that's a big deal, but that has kept me with Fidelity for a while. And I like the people at Fidelity. So if you need a referral over to Fidelity, just let me know. But I'm a big fan of the tools. And yes, that Fidelity Basket Portfolio, I have not used it. I have not played around with it. Jay says he plays with it to use the daily stock pick core portfolio and alpha picks. And again, alpha picks. If you want alpha picks, the tools that I include here, Trendspider, incredible platform. You get the 4-hour algorithm. You get everything for $53 a month. It is an amazing software tool. It's web-based, so it's on your browser. You can set up alerts. You can do all the scanners. You can do everything. I got to do a deep dive at some point. And then the other tools, this bundle. This bundle saves you $159. So all of the research that you've seen me do, for $600 a month, $600 a year, you save $159. That is a fantastic bundle. That is the deal of the century. And it's limited time, so sign up. I don't know when it's going to go up. They constantly just, raise the price. When people find it as useful as they do, they raise the price. That's just the subscription service. From Spotify, Rizzy Bobby, I mentioned IONQ in the comments about a month ago. Now I'm doubling down on it with recent news. It's a long-term buy and hold in my portfolio, IONQ to the moon. My response to Rizzy was, this is true degenerate behavior, but I wish you good luck with this. I'm not a hater. It's been a winner in the 4-hour algorithm. This has been it's up 4% today. Now, where do I think this one's going? When you look at the weekly, you don't have a 200-day. This one is not one that's making money. We can go over here. We can look at this. But this is quantum computing. And I do believe quantum computing is the future. And if you want to just Google quantum computing, but they bagged a $54 million contract with U.S. Air Force, and that was announced on September 27th. And I think they got additional money. I don't exactly know what happens, but they're losing money. And the valuation sucks. And the profitability sucks. When you look at Wall Street, there's 6 analysts that cover this. And the average price target is 10. You're at 15. Why are you at 15? My belief is that 18% short interest is driving this one up. Okay? It's got a $3 billion market cap. They're not making money. But you can absolutely, Michael Wiggins, who we look at a lot here as an analyst, who has called, I think it's APP really, really well. He said hold it back here on June 26th. He's lost out on 134%. He said hold it here on September 11th. He's missed out on 118%. Risk reward is kind of what you want. And Rizzy, I wish you luck. I hope this is the Tesla that you're sitting there with $60,000 in here, like I was with $65,000 in my Tesla car, which I should have bought in stock. But I hope you buying this stock is like Tesla, where that turns into a couple $1,000,000. And I hope that's what you get. So scans, let's talk about scans. And Rizzy, I do wish you luck. Honest to God, I'm not being coy with that one. I hope you and Brandon make a ton of money in that one. Costco, this one is a buy. $8.93. You're going to get October. We talked about how this one, the last 14 years, 100% in November, and it has a buy on October 23rd. Might be a good one. We talked about that one. So Tesla, we talked about how that one, I just can't see today how anything goes good for them. But again, it's been you have been a loser if you bet against Musk. And I do believe in Musk. He just attracts the best workers, and his product's just amazing. I mean, freaking chopsticks catch a 10-story building rocket that's falling at the speed of sound. Come on. And he's putting cars out there that will drive themselves just on cameras. You got to be, again, I'm only talking a short term. I still have good Tesla in the core portfolio. Google, another cross up here. It's just trading. I will tell you that 171, just their earnings are coming up October 29th. I can't imagine that this one all of a sudden with all of the DOJ stuff pops up here, but it could. I'm still holding this one. This one's still one of my top holdings. Now, a spider sector crossed up, XLP, and this is the last one that I'm going to go over because I do want to point this out. XLP, which is consumer staples, nice little entry here at $81. Okay, this one maybe gets another leg up. You don't have confirmation, but the Bollinger Bands are cinching up. It's on the downside. If consumer staples are to go down, maybe we're seeing that final pullback in the market prior to it going up. Now, XLP, consumer staples, has a very good fourth quarter. You can see October, 52%. Then you have November. Then you have December. And if we go over here, we look at the holdings. What's XLP's holdings? XLP, consumer staples. We can go and look at their holdings. Top 10, Procter & Gamble, Costco, Walmart, Coca-Cola, Pepsi, Philip Morris, which just gained like 10% yesterday, Colgate, Mondelez, Altria, Target, which we talked about yesterday, how they're expecting a big consumer rush for the holidays. So I like that one. Any questions you have, you can go over here to Linktree. Linktree has everything. It has Trendspider. You can bundle up, get that Seeking Alpha bundle. And if you don't want the bundle, say you don't want Alpha picks. You just want, you want to see the quant. You want to, import your portfolio. Seeking Alpha Premium's great. It's fantastic. You get a free 7-day trial. You don't get a free 7-day trial when you get Alpha picks. So when you get the bundle, you don't get a free 7-day trial. But if you want to try Alpha picks, you can absolutely sign up. Again, if you have a financial advisor, I would argue if he's not making you 145%, you're probably paying him too much money. Because Alpha Picks, their history, they're making 145% versus the S&P at 51% during that same time period. Go and look. Get more information on it. It is great. There is a full page here. I know I show you just the top of it, but it is a fantastic portfolio. Again, over the last 5 picks, they give you a pick on the 1st and the 15th. I've only mentioned one here on the podcast. So that is how good this, and all of them are up like 10, 15. I went over them in previous podcasts. It's really good. So if you have any questions, hit me up. The link tree has everything, including my email address right up here in the upper right. Okay.
Every morning I wake up to the sound of the trading bell. My heart starts to pound. Daily stock pick trading podcast in my ears, guiding me through my hopes and fears. Tune in daily, don't miss a single show. Sign up for the newsletter, let us help you grow. Taking risks, making moves, seeking success. Together we'll conquer, no room for any less. Every morning I wake up to the sound of the trading bell. My heart starts to pound. Daily stock pick trading podcast in my ears, guiding me through my hopes and fears.